Select 50 Fund Focus. I'm joined today by Julian Fosh, who is the co-manager of the Liontrust UK Growth Fund. Julian, thanks for coming in today.
No problem.
So I thought we'd start with economic advantage, which is the sort of underpinning of the UK Growth Fund. Maybe you could explain what that is and how it works.
Sure. So economic advantage is the name we give to our entire process, which we think is distinctive within the UK. And it incorporates three elements. Firstly, and most importantly, the foundation stone, if you like, we're drawing on intellectual capital, or to give it its other name, intangible assets, in explaining how a select group of companies have what we believe is an enduring competitive advantage. Intangible assets, people are familiar with the opposite, tangible assets. Tangible assets are the things that show up that you can touch, things that will show up in your balance sheet, which gives you a high degree of, I suppose, certainty as an investor they're not going to disappear or walk out the door. Intangible assets is about assets, advantages that businesses have, which are less easy to perhaps understand and grasp, and certainly less easy to capture via conventional accounting, because you can't touch them, but they are there nonetheless. Lots of work been done over 40, 50 years in academia and business schools on this subject, not so much in the city, which I think we think gives us an edge ourselves. So we start by saying there are three three types of intangible assets which tower head and shoulders above all others. And if you have one of these things, and only if you do have at least one of these three things, then you can make it into the fund. And those are intellectual property, some kind of competitive advantage stemming from the only truly unique thing that a business has, its own people. Strong distribution, that can be high market share or electronic or physical distribution, and high levels of recurring revenue. So if you have that, we think in theory, and it's obviously certain businesses have two and all three, but if you have at least one of those, we think in theory that gives you the ability to earn higher returns than the average company, and to do so for longer. Stage two of the process is to say, well, okay, we need to measure those returns to see if you are in practice achieving or succeeding in converting your theoretical advantage into an achieved advantage. The framework we use for that is cash flow return on capital, or return on capital, but simply we think there are a number of problems with using simple earnings for that. But then thirdly, most importantly, is the question of valuation. The stock market is a valuation mechanism. It's all very well to identify a group of terrifically achieving companies, but if you pay the wrong price, too high a price for them, you'll never succeed in achieving acceptable returns for your investors. So that, in a nutshell, is the economic advantage process.
Right, okay, so the valuation is an important part of the process. It's not just about buying great companies, whatever the price, and just holding them for a long time.
Absolutely not. I mean, we think a fundamental mistake, if we might say so, that a lot of people make is to start with valuation. We recognise the importance of valuation, but it's important to put it in its context, so we put it last. The reason for that, we think, is that valuation is often thought of as a science, but we'd say it's more of an art, really. Which valuation metric do you use? PE is widely used, earnings per share, but this is a one-dimensional measure. It often doesn't take account of the cost of financing the growth that it's designed to measure, and it's very short-term, in fact. So we favour a range of measures for every company certainly every large company that we buy into the fund, and UK Growth is predominantly a large company vehicle for our process, if you like. We look at them on 5 distinct valuation measures, so certainly PE, but also longer term measures, EV to sales, EV to EBITDA.
And by EV you mean?
Enterprise value, debt plus equity. Dividend yield, good old-fashioned dividend yield, which we used in Britain for many years before the PE crossed the pond from the States. And finally, free cash flow yield, because often cash flow can tell you a very important message about a business that's not evident from the other valuation metrics. So our rule is that we won't buy a new large company holding into the fund, unless we can identify that it's cheap against the market on at least one of these 5 measures on consensus numbers. And that way we hope to sort of not fall into the trap that many people fall into of overpaying for admittedly good companies.
Which is maybe a common failing of growth funds.
Absolutely.
Overpaying. Okay, so you talked a little bit about the size of companies. So it's largely FTSE 100, FTSE 250? Is that your hunting ground?
FTSE 350.
Yeah.
One of the fund can invest up to 10% in small companies, but no more than that. I mean, we've always had a strength at Liontrust in identifying small companies, and ideally, small companies will go on and grow to be large companies. But the main thrust of the point of the fund is to provide a vehicle for people who want what we do, but in the large company, not the small company sphere.
And what about sectors? I mean, I look at the top 10 holdings in the fund. I see oil and gas companies, pharmaceuticals companies, tobacco, some household products. They're all quite defensive sectors. Is that a deliberate feature of the fund?
Not defensiveness per se, but I mean, when you start, we very much pride ourselves on being bottom-up investors. So we start with the stocks. We don't at all care about the sector distribution. And what's evident, of course, when you look at sectors, is that some sectors have what we look for in abundance, superabundance, and some sectors don't have it at all. So, I mean, typically mining, we would say, is very much about tangible asset exploitation. You're really digging tangible assets out of the ground and then selling them at the prevailing price, whatever that is. Banking, a very big part of the stock market, we don't currently have any holdings in at all. Banking historically was a recurring revenue sector. Obviously, banks rather jettisoned that in the lure of much bigger one-off profits in the securitization boom, and they're still rebuilding. If you look at bank return on equity today, it's nowhere near the cost of equity and nowhere where it was on the long-term average. So
you sort of really focus on the companies, but of course, as an investor deciding which fund to buy, you are necessarily looking at different geographies and even different asset classes. But what would you say to someone who's trying to decide, is this the right time to invest in